What happens if your bank truly fails? Panic, lines, chaos. That was the old system. But here is the real question. Who pays the price? Not the government, not the owners of the bank. You do. You do not get a choice. You do not get a vote. You do not get an authority you can appeal to. You wake up one morning, and the $500,000 you saw in your account is gone. In its place, you have $262,500 worth of shares in your own failing bank because your bank took your money and converted it into bank capital, meaning your savings were used overnight to rescue the very bank that was supposed to protect you. This is not an exception. This is not a conspiracy theory. This is completely legal. Laws that quietly took effect after 2008 tell banks something like this. If you are failing, do not start with shareholders, start with depositors. So technically, the money in your account is not your money. It is an unsecured loan you have given to the bank. And this video is not about how money disappears. It is about why you cannot object when it happens. Because when the system is collapsing, everyone is in debt. But very few people know who the real creditor is. And if you're thinking, I do not have $250,000 in a bank, so I have nothing to worry about, think again. Because the issue is not how much money you have. The issue is where money sits inside the system. Local governments, major corporations, pension funds, hospitals and universities, energy and infrastructure companies. All of them keep hundreds of millions, sometimes billions, inside banks. And if those institutions lose access to that money, they cannot pay wages, they cannot pay bills, they cannot keep operating. At that point, the problem is no longer a bank problem, it becomes an economy problem. So what do governments do in that moment? They print money, a lot of money. And the cost of that money is always paid the same way, through inflation. So saying, I do not keep money in a bank does not remove you from this chain. Because when the system breaks, the cost is spread across everyone. Your whole life, you were told your bank money is safe. But today we live in a world where financial uncertainty and banking crises are part of normal conversation. So we have to ask the uncomfortable question, how true is it that your money is safe in the bank? History shows us, again and again, banks that were said to be unbreakable break. Structures called systemic collapse. Money that was called safe disappears. So when a bank fails today, what actually happens? And the real question is, who pays the bill? Now let's go deeper. There's a concept called bail-in. A bail-in is when a bank on the edge of failure is kept alive by using its own creditors. And that creditor is you, depositors. Because the moment you deposit money, that money is no longer yours. It becomes the bank's property. The bank gives you only one thing in return, a promise, a claim, an IOU. Technically, you are not a saver. You are an unsecured creditor lending money to a bank. And that small technical difference is what decides whether you keep your life savings or lose it overnight. Yes, your deposit account has FDIC insurance, but that insurance is only valid up to $250,000, which means anything above $250,000 is uninsured. And yes, there were exceptions. In cases like Silicon Valley Bank, the government and the FDIC also protected deposits above that limit, but that was not a guarantee. It was a decision. And not every crisis is met with the same decision. Has this happened in history? Yes, it happened in Europe, in Cyprus. People woke up one morning and saw that part of their bank deposits had been converted into bank shares. This was not a theoretical risk. It was executed. And in America, after the 2008 crisis, a major shift took place. In 2010, the Dodd-Frank Wall Street Reform Act was passed. That law ended the era where banks that were too big to fail would automatically be rescued with taxpayer money. And what replaced it? Bail-ins, meaning if banks are going to be saved, the money will no longer come from outside the system. It will be pulled from inside. And the largest pool inside the system is deposits. So this is not about fear. This is about knowledge. Because if this is how the system works, you need to understand how to position your assets. And that is exactly what this video is about. Over the last 12 years, 3 different countries, through 3 different methods, showed the same reality. In the middle of a crisis, a bank account stops being money you can use at will. And when that moment arrives, no one offers you choice. The first case was Cyprus. In 2013, Cyprus woke up one morning and saw the banks were closed, branches were locked, ATMs were limited, and a single question spread everywhere. Where's my money? When the banks reopened, the answer was even more shocking. For deposits above 100,000 euros, around 47% was gone. But it wasn't stolen, it wasn't lost, there was a legal decision. To strengthen the capital of failing banks, a portion of deposits was confiscated, meaning depositors were used to keep the bank alive. And in that moment, you realize something. In a crisis, a bank account is not a safe harbor. It can become the raw material of the crisis. Cyprus wrote the template. 2 years later, summer of 2015, Greece, This time the system didn't cut deposits directly. It used a more silent mechanism. It cut access. Capital controls arrived. People could withdraw only 60 euros per day from their accounts. That was all. Your money looked like it was there. It was on the screen. But in real life, it was not. You need to pay rent, buy groceries, pay for medicine, and the system gives you one breath of air, 60 euros per day. Transfers were locked, paying abroad, sending money to suppliers, supporting family, making wire payments. Everyday life suddenly returned to a cash economy, but there wasn't enough cash. Greece taught a brutal lesson. Being able to see your money does not mean you can use it, and that lock did not last a few days. It became years. Then, 2019, Lebanon. And perhaps the most painful lesson was written there because that story still hasn't ended. Banks began limiting withdrawals, at first unofficially, then as a full, real regime. Even people with millions of dollars could not withdraw more than a few $100s per week, and their statements still showed the same balances, as if everything was normal. But in reality, there were no dollars inside the system. The money was either already gone, or it was trapped inside a structure that grew on paper while collapsing in real life. 6 years passed. Many people still could not access all their savings. People walked into banks trying to force their own money back out. Those scenes were the moment finance stopped being numbers on a screen and became survival. Lebanon taught this. Sometimes your money is not cut. Sometimes it is not merely locked. Sometimes it is simply not returned. 3 countries. One outcome. Cyprus. Money was cut. Greece. Money was locked. Lebanon. Money was suspended. Different mechanisms. Same result. In a crisis, depositors may not be the protected side. And now we reach the most critical point. You can dismiss those examples as weak countries. You can say, that could never happen in America. But here's the terrifying part. In America, the next crisis does not require a new idea. It only requires an existing framework to be activated. In 2008, the model was simple. When losses became too large, the state injected money from outside, kept the system alive, and the public carried the cost. Then the political backlash came. The idea rose, taxpayers should never pay again. And the story split into a new path. Because when a bank collapses, the loss cannot vanish. Someone must absorb it. Shareholders go first, then bondholders. But if that is not enough, the next layer is the bank's creditors, and depositors are creditors too. That is why, in the next crisis, the question is not, will banks be rescued? The real question is, which pocket will the rescue bill be written to? This video is about how modern systems fund crises not from outside, but from inside. And the most dangerous part is that this is no longer an extraordinary idea. It is a mechanism that activates quietly in a crisis. Now we are going to break the pattern down. Why was this structure built this way? Which decisions normalized it? And why are savings more fragile than we think? Now pause and ask this. What did these 3 countries truly have in common? Not weakness, not size, not even mismanagement. The common point was this. Their banking systems had grown larger than the state could ever rescue. This is not a moral question. It is a math question. When do banks become unrescuable? When a country's banking system grows to multiple times its economy, the question becomes meaningless. Will the government rescue the banks? Because the answer is, it cannot. In Cyprus, banks reached roughly 800% of GDP. In Greece, over 300%. In Lebanon, around 400%. No state, no matter how much it wants to, can carry that weight. Now look at America. In the US, the total assets of just 6 major banks exceed $12 trillion. That is nearly half of the US economy. Just 6 institutions, and that is only the visible part. So the question is not, can a bank fail? That question has already been answered. We saw it in 2023. Silicon Valley Bank, Signature Bank, First Republic, all collapsed within weeks. The real question is this: what happens if multiple banks come under stress at the same time? Because the system was designed to survive isolated failures, not chain reactions. In the past, a bank run looked like this: a line outside a branch, panic, newspaper headlines. That is not how it happens today. Today, a bank run is an app, a screen, a transfer button. That is what happened at Silicon Valley Bank. People did not go to branches. They opened their phones. And in less than 24 hours, $42 billion left the system. That speed has never been seen in history. No bank can lose a quarter of its deposits in one day. The math does not allow it, and that speed revealed an irreversible truth. In the era of digital banking, bank runs cannot be stopped. Not all the money deposited in a bank sits in a vault. Only a small portion is reserves. The rest is turned into loans, bonds, and assets, meaning most of the money in your account is not actually there. That is not a problem. That is how the system works. The problem starts now, when everyone wants their money at the same time. Then the line is not outside the bank. The line forms on the balance sheet. And under panic, balance sheets collapse fast. At this point, people usually say, There is FDIC, deposits are insured. That is true, but incomplete. The FDIC fund is roughly $125 billion. Total insured deposits in the US exceed $10 trillion. That is barely over 1% coverage. So the system runs on one assumption. Not everyone comes at the same time, but modern crises do exactly that. They move everyone at once. The FDIC fund can handle a few mid-sized failures, not a wave. And that is where the system's true priority becomes visible. Not the individual depositor, but the continuation of the system. A bail-in is not an emergency decision. It is not invented during panic. It is already written. In a crisis, the objective is simple: keep the bank alive. But the old choice is no longer used. Let taxpayers pay. Instead, use internal capital. And the largest internal capital inside a bank is deposits. At that point, deposits stop being money. They become a tool. Because this system was not designed to be debated during panic. It was written to be approved before the crisis. And when the crisis arrives, it is already approved. When people object, the answer is ready. That is the law. Just like Cyprus, just like Greece, just like Lebanon. And every time, people say the same sentence: I never thought it would happen to me. The issue is not, will there be a crisis? The issue is, when the crisis arrives, which tools will be used? And in today's system, the fastest, quietest tool, the one that creates the least political resistance, is deposits. And that is why the real risk is not the bank failing. The real risk is that your money is used to prevent the bank from failing. From here, we will do two things. We will explain why the system was deliberately built this way and what an individual can do, step by step. Because from this point forward, it is not about fear, it is about positioning. At this point, most people ask, why does the depositor always lose? The answer is not simple, but it is clear. Because the modern financial system pushes fragility downward. At the top is the state. Below that, central banks. Below that, major financial institutions. And at the bottom, waiting silently, the depositors. Risk is produced at the top, but the cost is paid at the bottom. This is not a conspiracy. This is a design. Modern banking is built on trust. But this trust is not moral. It is behavioral. People believe, my money is there. I can withdraw it when I need it. The government won't allow anything to happen. The system runs on that belief. But when that belief is questioned, the system locks up fast. That is why transparency does not increase during crises. It decreases. Because transparency does not trigger trust. It triggers panic. Because if there is warning in advance, people withdraw money. If money is withdrawn, the bank collapses. If the bank collapses, the system collapses. That is why crises often happen on weekends. That is why decisions are made at night. That is why new rules appear by Monday morning. This is not a coincidence. In Cyprus, banks closed on Saturday. In Greece, the decision came on a Sunday night. In Lebanon, restrictions arrived overnight. The timing is always the same, because the objective is to prevent escape. Many people think, my money is small, it doesn't concern me. But in crises, individual size does not matter. Total impact does. What happens if a hospital cannot access its bank funds? What if a municipality cannot pay salaries? What if an energy company cannot import? Then the crisis stops being personal. It becomes social. And in that moment, the state does not solve the problem. It buys time. And the easiest way to buy time is to lock the money. They always call it temporary, but it almost never ends quickly. Because when controls are lifted, the escape begins again. In Greece, controls lasted 4 years. In Cyprus, they were lifted slowly over years. In Lebanon, they still continue. Once control arrives, it never fully leaves. It only changes shape. Now we need to make a critical distinction. In crises, people often do not lose their money. The money may still be there, but they lose access. And money you cannot access is effectively gone. The number on the screen is not reality. Reality is what you can use. That is why crises teach a brutal lesson. A bank account is not a safe box. It is a promise. And in a crisis, promises get rewritten. History is very clear. Banks take risks. The state protects the system. The depositor gets trapped in the middle every time. And every time people say, this time is different. But it never is. Only the method changes. One time bail-in, one time capital controls, one time a temporary freeze. But the result is the same. Your money is not under your control. Everything we have covered so far is not a prophecy, not a theory. It happened in 3 countries. The legal framework exists. It is a repeating pattern. In the next part, we will ask, why has this pattern become unavoidable in the modern world? And why were central banks placed at the exact center of the system? Because the story does not end here. It begins here. What we have seen so far is this. The problem is not individual banks. It is not even individual countries. The problem is how decisions are made during crisis. And most of those decisions are no longer made by elected governments. They are made by central banks and regulators. How did we get here? At first, central banks had a limited role: provide liquidity, organize payments, calm panic. But over time, they realized something. If you control credit flow, you control the rhythm of the economy. Interest rates are not just an economic tool. They shape behavior. When rates fall, people borrow. When rates rise, people retreat. That is economic truth, but also political power. And in crises, that power becomes extraordinary authority. In a banking crisis, you always notice the same pattern. The central bank speaks. The regulators step in. The government stays in the background. Because this domain is labeled technical, and technical domains get removed from democratic debate. That is a deliberate choice. Because in crisis, you do not want debate. You want decisions. The price of fast decisions is the exclusion of participation. Bail-in authority fits perfectly into that logic. Because bail-in is technical. Its political cost is lower. No tax increase, no visible budget deficit. But the impact is massive. And most importantly, it is quiet. Depositors are scattered. They are not organized. Their voices arrive late. So from the system's perspective, they are manageable. Not morally, operationally. At some point, the system realized something else. You cannot erase debt directly, because trust collapses. But you can erode debt in value. That is why inflation is not a side effect. It is a tool, quiet, spread over time, hard to measure who loses how much. And most importantly, no one can be blamed directly. That is why, after massive debt buildups, history repeatedly produces inflationary eras, not by accident, by function. Modern crises are more dangerous because the speed changed. A bank run used to take days. Now it takes minutes. Information used to spread slowly. Now it goes global in seconds. That is why warning in advance is impossible. Warning equals collapse. So decision makers move toward harder, sharper measures. Like the system is not trying to destroy you. The system is trying to continue. And to continue, it does three things. It individualizes risk. It spreads losses. It centralizes control. That is why each crisis produces more regulation, but not more freedom. More rules, fewer options. This is not a call to panic. This is not fear. This is a map drawn in the past and tested many times. And the map says this: modern economies cannot live without debt. Debt crises are unavoidable. And in crisis, the priority is not the individual. It is the system. In the next part, we will explain why this structure has become unsustainable and why every new crisis is harsher than the last. Because the system is not only fragile, it is aging. And aging systems produce crises more often. Now we reach a critical truth. The system had crises before. So why are today's crises more frequent, more severe, and more uncontrolled? Because the system grew, but the support columns stayed the same. In the past, debt was cleared in three ways: war, default, high growth. Today, none of those work. War increases global risk. Default creates chain collapse. And high growth is gone. Because growth is now financed by debt. The tool used to clear debt has become the debt itself. That is a loop. And loops eventually tighten. This is the central bank's real dilemma. They must do two things at once: keep the system alive, control inflation. But those goals now collide. If rates rise, banks take losses. Government debt becomes expensive. Markets crash. If rates fall, inflation rises, currency erodes, purchasing power collapses. So central banks no longer choose good. They choose less bad. And the cost spreads through society over time. And in every crisis, one word appears: temporary. Inflation is temporary. Rates are temporary. Liquidity measures are temporary. But these temporary measures never truly leave, because every crisis stacks on the previous one. What was extraordinary yesterday becomes normal tomorrow. So who must the system protect? The answer is uncomfortable but clear. The system protects the biggest nodes: major banks, government bond markets, global payment systems. Because if one falls, the others fall too. Individuals are dispersible risk. That sounds harsh. But Cyprus, Greece, and Lebanon prove it in reality. And every time people say, Cyprus is small, Greece was mismanaged, Lebanon is an exception. But systems do not run on exceptions. They run on mechanisms. America's difference is simple. It experiences the crisis later, but when it arrives, it is bigger. Because scale is bigger, connections are denser, chains are tighter. That is why warning is avoided. Because warning equals panic. If a regulator says banks are at risk, the risk becomes real immediately. So the system prefers silence, soft language, technical explanations. And behind the curtain, extraordinary authority stays ready. The real break is not in banks. It is in trust. The moment people truly understand, is this money really mine? That is when the ground cracks. Because modern banking is not built on physical cash, it is built on belief. And when belief disappears, no balance sheet is enough. So stop and ask. If the system produces more debt, creates more frequent crises, and requires harsher controls, then the question is not, when is the next crisis? The question is, Has the payer already been chosen? In the next part, I will show why the system is moving into an irreversible path, and why every new crisis leaves fewer choices. Because this is no longer about money, it is about control, and control changes hands in crisis. Now we have crossed an important threshold. What used to be extraordinary has quietly become standard procedure, and almost no one noticed the transition. Control no longer arrives as obvious force. Obvious force creates resistance. Technical decisions do not. Today, control is packaged as an emergency measure, a financial stability tool, a system security requirement, and those words are rarely questioned. Nobody wants to be against stability. Nobody wants to say, let markets collapse. So control is presented as technical, not moral. Capital controls are no longer an old concept. They used to be associated with weak economies, but today the same tools appear in advanced countries under different names. Liquidity management, temporary transfer limits, systemic risk measures. The result is the same. Access is restricted, movement is slowed, options shrink, and digitalization is the key, because digital money removes physical limits, but it also centralizes control. Cash is invisible, hard to track, hard to freeze instantly. Digital money is trackable, freezable, and can be made conditional. That is why digitalization is not only convenience, it is governance. So who wins and who loses? Winners. Those who manage debt, those who allocate liquidity, those who write the rules. Losers. Those who keep savings in banks, those with one income stream, those who sit as the last link in the chain. Because in crises, the weight moves downward. Shareholders lose, bondholders lose, but at the end, depositors are there. And depositors are the largest group. So why is it barely discussed? Because if it is discussed, bank runs accelerate. Markets can freeze. The crisis can arrive sooner. So silence is the reflex. But history shows silence does not stop a crisis. It only increases the number of people caught unprepared. And the greatest danger is this. Everything is legal. Bail-ins are legal. Capital controls are legal. Account freezes are legal. So when it happens, it is not presented as injustice. It is presented as procedure. And no one apologizes for procedure. So here's the final question you must ask. If access to money can be limited, if savings can be transformed during crisis, if rules can change mid-crisis, then the issue is not money, it is authority. And authority concentrates at the center with every crisis. Cyprus was shocked. Greece waited. Lebanon lost hope. But all shared one sentence. We never thought it would happen to us. History does not repeat perfectly, but patterns repeat. And that pattern is now clear. In the next part, we will talk about why the system is approaching a point of no return, and why individuals have fewer and fewer options inside it. Because the issue is not knowing what will happen. The issue is what you can do while it is happening. Now let's state the critical truth. Returning from the system is not difficult. It is structurally impossible. Because modern economies cannot function without debt. Debt used to be a tool, now it is fuel. Government budgets run on debt. Companies expand on debt. Consumption survives on debt. Pension systems depend on bond markets. The moment you remove debt, spending falls, unemployment rises, tax revenues collapse, the system locks. That is why no one truly wants to end debt. They want it to look manageable. And interest rates can never stay normal. High rates crush government budgets, pressure banks, and break the debt chain. Low rates make debt look sustainable, inflate assets, and buy time. So rate policy is not an economic tool. It is a time-buying tool. And time becomes more expensive in every crisis. Inflation is not just rising prices. Inflation is debt being erased quietly, savings being eroded slowly, burden being transferred without triggering revolt. It is not like a tax. It requires no vote, no bill, no public debate. But it works. That is why it is chosen. So why do people still act surprised? Because the system teaches them rules are fixed, banks are safe, the state will protect you. But history shows rules change in crisis. Trust is measured in crisis. The state protects the system first. The individual is last. The real break happens when people realize this system exists not to save me. It exists to keep itself alive. And when that realization spreads, behavior changes. People want cash. People seek alternatives. People start asking questions. And that is exactly when authorities panic. Because the system survives on habits, not questions. That is why knowledge is treated as dangerous. Because knowledge accelerates bank runs, triggers capital flight, and makes control harder. So it is not explained. It is simplified. It is called technical detail. But those technical details decide the fate of the money you spent your life building. This is not a prophecy, not a conspiracy, not a guess. It is a repeating model. Banks grow, risk accumulates, a trigger arrives, controls activate. The cost falls to the bottom every time. So let me leave you with one final question. If control of money is not yours, if rules change in crisis, if your savings depend on decisions made above your head, Then what are you in this system? A participant or just a line item on a balance sheet? In the next part, we will examine how this structure keeps individuals indebted, dependent, and immobile, and whether this is coincidence or design. Because the answers are not in the future, they are in the past. And without looking there, you cannot understand what is happening now.